Hello, everyone. I'm Mark Duggan, the director of the Stanford Institute for Economic Policy Research, and thank you so much for joining us today for our associates meeting with Chris Waller from the Federal Reserve Board of Governors. Today, I'm delighted to pass the proverbial baton to my friend and colleague, Monika Piazzesi, who is a professor in the economics department and a senior fellow with us here at SIEPR. And Monika will be moderating the discussion today with Governor Waller. So Monika, take it away.
Thank you very much, Mark. Welcome everyone to today's event with Federal Reserve Board Governor Chris Waller, which is hosted by the Stanford Institute for Economic Research. I'm Monika Piazzesi, a senior fellow at SIEPR and an economics professor here at Stanford. We've had a good deal of excitement at Stanford lately, particularly among economists, as my colleague Guido Imbens was a co-recipient of the Nobel Prize in Economics that was awarded last week. Guido is also a senior fellow at SIEPR, and it's really great that he and his influential work on econometrics have received this recognition. Along with supporting scholars like Guido and myself, SIEPR also does a tremendous job in connecting academics with policymakers, and today's event is a great example of that. I'm very eager to hear from Chris Waller, the newest member of the Board of Governors, and to have a discussion with him about lots of topics: inflation, the labor market, central bank digital currency, crypto, house prices, and lots of other things. Chris joined the Board of Governors almost a year ago in December 2020. When Chris became governor, every single economist I know was celebrating and very happy to know that the Federal Reserve Board would be in such excellent hands. Chris is a very well-known and widely respected expert on the different forms of money, including central bank digital currency, innovations in payments more broadly, the welfare cost of inflation, the optimal conduct of monetary policy, the role of banks in the economy, and central bank governance. He's published many research papers in academic journals on these topics, and so he is in many ways the perfect Fed governor. Before joining the Board of Governors, Chris was the Executive Vice President and Director of Research at the Federal Reserve Bank of St. Louis. He's well known to have done an amazing job as research director. He attracted an outstanding group of research economists to the St. Louis Fed, many of whom gave up faculty positions at prestigious universities to come work with Chris in the research department. Before joining the St. Louis Fed, Chris headed the economics department at the University of Notre Dame, where he was the Gilbert Schaefer Chair of Economics and also a research fellow with Notre Dame's Kellogg Institute for International Studies. Before then, Chris taught at the University of Kentucky and Indiana University. Chris earned his undergrad degree in 1981 at the Bemidji State University in Minnesota and his PhD in 1985 at Washington State University. If you have any questions for Chris, you can submit them using the link just below this video in the chat. With that, please join me in welcoming Chris Waller.
Thank you, Monika, and thank you to the Institute for the opportunity to speak to you. Today, my goal is to explain my outlook for the US economy as well as how that perspective shapes my views on the appropriate approach to monetary policy. I have 3 points I would like you to take away from my comments. First, while there has been a significant slowdown in the third quarter in GDP growth, it should rebound in the first half of 2022. Second, I believe that substantial progress has been made on both the inflation and employment legs of our dual mandate. Hence, I believe that we should soon commence tapering of our asset purchases. Finally, the next several months are critical for assessing whether the high inflation numbers we have seen are transitory or not. If monthly prints of inflation continue to run high through the remainder of this year, a more aggressive policy response than just tapering may well be warranted in 2022. In terms of economic growth, data for the third quarter of 2021 showed that the economic recovery slowed as the effects of the Delta variant caused consumers and businesses to start pulling back on some forms of economic activity, such as travel and leisure. Measures of consumer mobility, which are a good indicator of spending, grew strongly starting last winter, but then started falling in June, around when the effects of the Delta variant started to become significant. I and most other forecasters expected that real GDP would grow close to the very strong rate posted in the first half of the year, but it now appears that GDP growth will be closer to 3% at an annual rate. The two major causes of this GDP slowdown have been the extent of the economic effects of the Delta surge and the extent of supply constraints, both of which had larger effects than I and most expected. That was due to both the disappointingly low levels of vaccination in some areas and how highly contagious Delta proved to be. Meanwhile, we have seen labor shortages in many regions and many sectors that seem unwarranted given the level of unemployment and other indicators of slack in the labor market. And supply constraints have been very widespread, as we know, with many causes, only some of them directly related to COVID-19. US imports have been disrupted both at the point of export and at US ports, with backups at major ports larger than some have ever experienced. Thus, a lack of inputs and a lack of labor to use those inputs have created a dramatic headwind for GDP. Fortunately, there is already evidence that the Delta surge has begun to wane. And with the reopening of schools and the expectation that they will remain open in most areas, the worst effects of Delta medically and economically may be behind us. Likewise, fears that Delta would lead health officials to mandate more severe business restrictions have not materialized. Furthermore, the spread of the Delta variant has raised vaccination rates even in areas where they had been low, which will help contain the spread of the variant. All of this recent experience encourages me to believe that the moderation in the expansion of economic activity in recent months that is directly related to the Delta surge will be a temporary phenomenon. I expect that this slowdown has only delayed the economic recovery into the first half of 2022. And thus I have moved that growth from the second half of this year into the first half of next year. This delay means that my medium-term outlook for economic growth really has not changed much. And I forecast a strong recovery of the US economy will continue. Let me turn to the recent job reports in the labor market. For the month of August, I and many forecasters expected the economy would create 700,000 jobs or more. But the initial came in at a disappointing 235,000. Hopes turned to September, but that report disappointed as well, with 194,000 jobs created. Despite these unexpectedly low numbers, there was still some good news from the September report. Namely, that the disappointing number was due to unexpected declines in employment by state and local governments that may be attributed to a limited labor supply that will work itself out in coming months. Private payrolls, on the other hand, increased a healthy 317,000 jobs in September, and the July and August payrolls were revised up 169,000 jobs. Nevertheless, the numbers are concerning, given that as many as 8 million workers may have rolled off unemployment insurance programs in September. It is difficult to imagine that going forward, these workers will continue to remain on the sidelines. This suggests to me that we may be in for very healthy job gains in the last quarter of this year as these workers finally begin to fill the enormous number of available jobs. The September jobs report also showed the unemployment rate falling 0.4% from 5.2 to 4.8%. It is striking that in only 6 months, the unemployment rate has fallen from 14.8% in April of 2020 to just 4.8% now. So we are clearly most of the way back to a very strong labor market that we achieved before the pandemic. However, one data series, such as the unemployment rate, is insufficient at capturing the overall status of the labor market. Our assessment of the labor market must be broad-based which is why I look at more comprehensive measures of labor market health. Two that I find particularly useful are the Atlanta Fed's labor market spider chart and the Kansas City Fed's labor market conditions indicators. The Kansas City chart nicely condenses 24 different measures of the labor market, and the index is now above its long-run historical value. The Atlanta Fed spider chart shows that where each of 15 labor market indicators sits relative to different dates, such as February 2020 and September 2021. The spider chart reveals that 9 of the 15 indicators, including those for wages and job openings, are either better than February 2020 or nearly as good. Consequently, both measures of broad labor market performance reveal a significant degree of healing in the US labor market. So let me focus on the Federal Reserve's goals for monetary policy. As the minutes of the September FOMC meeting conveyed, many participants judged that we have achieved substantial progress on our inflation goal. With regard to substantial further progress on our employment objective, I believe we have now met that criterion, despite the jobs reports for August and September. We lost 22 million jobs in the early months of the pandemic recession. 2 million of those jobs are likely gone forever due to early retirements. We have now regained approximately 17 million of those jobs, or 85% of what was lost, after adjusting for early retirements. Furthermore, the September unemployment rate of 4.8% is not that far from the 3.5% unemployment rate that was realized in February of 2020. In summary, the labor market has experienced a healthy recovery, but it is not fully healed. While there is still room to improve on the employment leg of our mandate, I believe we have made enough progress such that tapering of our asset purchases should commence following our next FOMC meeting, which is in 2 weeks. Let me turn to inflation. Inflation has been running higher this year than I and most forecasters expected. It has not been high for just a month or two. It has been high all year. It is important to acknowledge that the unexpected inflation we have observed has raised costs for households and businesses and complicated their planning, which has a real effect on people's lives. For the Fed, the question is whether higher inflation this year undermines moving toward our economic goals. On that score, I continue to believe that the escalation of inflation will be transitory, the dreaded word transitory, and inflation will move back towards our 2% target next year. That said, I am still greatly concerned about the upside risk that elevated inflation will not prove temporary. We have seen substantial increases in many prices. Lumber prices skyrocketed through May, but then largely retraced that increase in the past few months. Prices for used cars rose substantially from mid-2020 to mid-2021, but now seem to have stabilized at this higher price level. At present, I am closely watching prices for housing services, rent, and owner's equivalent rent, which saw modest increases last year, but have picked up noticeably recently. In addition, energy prices have moved up noticeably in recent months, and market conditions suggest there is a risk of further increases. As I said earlier, I still see supply and demand working here to moderate price increases so that inflation moves back towards 2%. But I also see upside pressures on inflation that bear watching. Bottlenecks have been worse and are lasting much longer than I and most forecasters expected. An important question that no one knows the answer to is how long these supply problems will persist. Through our business contacts, we continue to hear stories about bottlenecks at almost every stage of production and distribution. For example, plants that shut down because of a shortage of one or more crucial inputs, a poor cotton crop in the US due to weather, which is driving up prices, and clogged ports and trucker shortages. Meanwhile, wage gains have been strong. That apparently has not made its way into prices yet. But how long before it becomes a driving factor in inflation? Firms are reporting that they have more pricing power now than they have had in years, as consumers seem to be accepting these higher prices across the board. The simple answer is I believe the next few months will be crucial to understanding whether elevated rates of inflation last and if that will trigger a lasting effect on the US economy. We will know more as time goes on about whether inflation in these prices of these goods and services will level off or even fall, as lumber prices did, and other prices will evolve. But importantly, we will also know whether this period of higher inflation has started to affect expectations of future inflation. A critical aspect of our new framework is to allow inflation to run above our 2% target so that it averages 2%. But we should do this only if inflation expectations are consistent with our 2% inflation target. If inflation expectations become unanchored, the credibility of our inflation target is at risk, and we likely would need to take action to re-anchor expectations at our 2% target. This raises a couple of key questions. Whose expectations do we examine, and how do we determine if they are unanchored? With regard to the first question, we measure inflation expectations two ways. First, we survey the public and ask them what they expect inflation to be in coming years. The University of Michigan Household Survey and the New York Fed Survey of Consumer Expectations are examples of this survey approach. Second, we can infer inflation expectations from differences in yields between Treasury Secretary's securities that are indexed for inflation and those that are not. These break-even inflation measures from the Treasury inflation-protected securities market are referred to as market-based measures of inflation compensation. Now, survey measures give us an idea of what the average American household expects inflation to be in the coming years. Presumably, this measure of expectations is important because it should influence households' wage demands as they seek compensation for an increased cost of living. Now, a key drawback of these measures is that the respondent incurs no benefit or cost from the accuracy of their forecast. They have no skin in the game. This is why I've always preferred market-based measures of inflation expectations, because they are formed by investors who are betting with real money about future inflation. In short, they have skin in the game. So this brings us to another question. Are inflation expectations anchored around our inflation target of 2%? Survey measures have shown a dramatic increase in inflation expectations over the past few months. The recent New York Fed measure has short and medium-term inflation expectation at 5.3 and 4.2%, respectively. This is eye-opening and a genuine cause for concern should households embed these expectations in wage demands. However, market-based measures of inflation expectations and the 5-year inflation expectations from the New York Fed survey continue to be anchored near our 2% target. I also look at the Board of Governors staff's common inflation expectations measure, which distills signals from both surveys and market-based inflation gauges. At this point, at least, it remains near its average over the last decade. This gives me some comfort that the recent run of high inflation readings has not led to an unanchoring of inflation expectations. Nevertheless, it is important to account for all measures of inflation expectations and not cherry pick the measure that one finds most comforting. So I'd like to follow up on this last point as it pertains to thinking about inflation. As I mentioned earlier, a lot of commentators, including myself, have deflected concerns about high inflation readings being the result of outliers or idiosyncratic price movements. As a result, recent high inflation readings are transitory and not broad-based. But there is a fallacy in doing so that one should avoid in judging whether higher inflation is indeed transitory. A basic tendency of statistical analysis is to exclude outlying or more volatile data. There are sound reasons for this, such as when we exclude volatile food and energy prices to get a measure of core inflation. That kind of measure often is more stable and can tell us whether the underlying forces behind inflation are moving as rapidly as it might seem from headline. A similar logic applies to trimmed mean measures of inflation, such as the Cleveland Fed Trimmed Mean Consumer Price Index and the Dallas Fed Trimmed Mean PCE inflation rate. These measures censor the tails of the price change distribution to avoid having average inflation distorted by extreme price movements. However, inflation is distilled from many prices, and those prices don't move uniformly or in small amounts. As a result, we may be led to falsely dismiss certain price movements and risk being misled as to the true inflation rate. Let me use a simple example to illustrate the point. Consider a three-good economy with goods A, B, and C, and look at how their prices increase over time. In one world, the price of each good goes up 2% every year. Thus, the average inflation is 2% every year, and there's no reason to question that measure as it is broad-based and equal. This is typically what economists and policymakers have in mind when we think about trend inflation. In this world, inflation would be meeting the FOMC's 2% target, and there's no need for policy change. Now consider a world in which there are sharp price changes that are staggered across goods. In year one, the price of good A goes up 5%, while the price of goods B and C only increase 2%. If we assume equal weights for each good, the inflation rate for this economy is 3%. This repeats in year two, except it's now the price of good B that goes up by 5%, while the other two go up at 2%. And finally, in year three, good C goes up by 5%. Now, in the economy I just described, inflation averages 3% each year, and each good goes up by 3% on average over 3 years, which would be above the FOMC's 2% inflation target. Now, take that data and think about manipulating it in several common ways that we do. First, if one uses a trim mean measure of inflation, you throw out the highest and the lowest readings of the year. And what do you get? The average inflation rate would be 2%. Thus, over a 3-year period, a trim mean measure would be 2%, indicating we're hitting our inflation target when the true measure of inflation is actually 3% per year. A second way of manipulating the data is to say, look, inflation is driven by good A, which had this idiosyncratic outsized price increase. If you throw it out, the underlying inflation rate is 2%. Then in year two, you say, well, good B had an idiosyncratic price increase, so throw that out. Repeat for year three. Again, by selectively throwing out unusually high price increases for individual goods, you would conclude over the 3-year period that inflation was hitting your 2% in target, when in fact, it was actually 3%. Third, one can justify throwing out good A in the first year by saying it did not reflect a broad-based price increase. The prices of 60% of the goods rose 2%. So based on those goods, we are hitting our inflation target. You would be correct, but again, misguided. Finally, one could claim correctly that the large price increase for good A is transitory. It went up strikingly in year one, but then dropped back, meaning inflation should fall back to our inflation target in coming years. But that will mislead you in terms of understanding the true inflation rate, because you are putting zero probability that that large spike inflation will happen to another good in the future. So the moral of this little example is that one needs to be careful when selectively ignoring data series, be it used car prices, food and energy prices, or household surveys of inflation expectations. All of these series convey important information about the evolution of inflation, and one should exhibit caution in dismissing data as outliers. We must keep our eyes open to inflationary pressures wherever they come from, with consistency and rigor, and stand ready to adjust policy if we conclude such a change is warranted. This brings me to how I believe monetary policy should evolve in the coming months based on the outlook I have described. The near-term decision we face is when to begin slowing the pace of asset purchases, which have each month been adding to the level of financial accommodation provided by the Fed to support the economy. Our test for this step was making substantial further progress toward our employment inflation goals. After years of running below 2%, the recent and sustained increase in inflation clearly represents substantial progress towards our goal. And the continued gains in employment, despite a couple of months of a slowdown, along with results across a range of labor market indicators, indicate to me that there has also been substantial further progress towards maximum employment. I support the FOMC beginning to reduce asset purchases following our meeting in November. Importantly, this action should not tighten financial conditions since a late 2021 tapering has already been priced in by most participants. One issue on which we should also be clear is the pace of tapering. I have said in the past that I favor a pace of tapering that would result in the end of asset purchases by the middle of 2022. Of course, if economic conditions and the outlook were to deteriorate significantly, we could slow or pause this pace of tapering. And if the economy were to strengthen more than expected, the plan to rapidly end purchases could provide policy space in 2022 to act sooner than anticipated to begin raising the target range for the federal funds rate. Based on my outlook for the economy, however, I do not expect liftoff to occur soon after tapering is completed. It's important to keep in mind these are two distinct policy actions based on different data. I believe the pace of continued improvement in the labor market will be gradual, and I expect inflation will moderate, which means liftoff is still some time off. That said, as I mentioned earlier, if my upside risk for inflation comes to pass, with inflation considerably above 2% well into 2022, then I will favor liftoff sooner than I now anticipate. A major consideration will be my judgment about whether inflation expectations are at risk of becoming unanchored, rising substantially and persistently above 2%. My FOMC colleagues and I will be watching all the data carefully in the coming weeks and months, and will adjust policy as needed to help ensure the U.S. economy continues to recover from the effects of COVID, and that we can continue to make progress toward our economic goals. Thank you.
Thank you very much, Chris, for a great talk. So you mentioned these upside risks that you view. And so let me start with my first question would be, some people talk about returning to the 70s, so the stagflation of the 70s. And so I would like to sort of learn from you, how do you think about the risks involved of going back to the 70s? Is that a substantial risk, or is that not something to worry much about? How can we assess that?
Yeah, so I think when I think of stagflation, I think of high inflation and high unemployment. Right now, unemployment is 4.8% and falling. So it doesn't look like we're moving into the traditional definition of stagflation. We also have enormous number of job openings. Normally in a stagflation environment, jobs are scarce, firms aren't hiring, which is why unemployment is high. We've got this very strange situation where we have more jobs available than people that are out of work, looking for work. That is just a strange environment. And as economists, we know that something has to give to make those two things equilibrate. So that's why I think going forward, the people that rolled off the unemployment rolls, some of those people will not return back to the labor market, but many of them will at some point. And I think in the next few months, people will start to move back in that direction. And then we'll see the unemployment rate drift down even more jobs created. And so we won't have anything that looks like stagflation. We may have inflation that's too high, but it won't be coupled with this bad labor market.
And we have a question from the audience that asks about the connection between the administration's plan to add $3.5 trillion in spending and inflation. Is this a concern of you that this might push up further inflation?
Well, the typical role of a Fed official is not to comment on fiscal policy. We just take what they do and make our decisions. Certainly from typical Econ 101, if you had a large stimulus program or deficit spending program, that should have a bunch of demand effects that could push up prices. That's just Econ 101. It's nothing deep from a policy point of view. If that spending is spread out over a decade, then the immediate impacts are probably not going to be as severe. So the infrastructure bill, as I understand it, spread out over 10 years, say $1 trillion. That's less likely to have the kind of impact on inflation that, say, a $4 or $5 trillion stimulus bill in the immediate 2 years, what that would have. But at the Fed, we just take fiscal policy as given and then see how it impacts GDP and inflation, unemployment, and then we make our actions based on that.
Another question we have is whether the stimulus bill is going to basically have help with economic recovery. Do you see the role as important for that?
Well, I think the recovery has come along dramatically. As I said, if you think about unemployment falling 10 full percentage points in 16 months, I mean, this is just mind-boggling. We've never seen anything like that in the data. So I always attribute that to that this was a very different type of shock than what we saw in past recessions. It had almost the storm effect. Everybody runs in, closes the doors, sits it out, and then comes back. Now, it's been a lot rougher in terms of recovery. That's what we're seeing with all the supply chain problems. But it's not surprising, in fact, that the labor market rebounded, as fast as it did. I mean, we've still got a ways to go. I'm not saying we've come all the way back, but in 16 months, you compare it to the last recovery. I mean, this is just astounding. So I think the stimulus packages, the fiscal packages, the income support that we raised, those were all needed at the time and done. But the labor market and the economy we're back above pre-GDP trend. I mean, that's amazing. You're back above trend in 16 months. Again, that doesn't typically happen the last few recessions. So in terms of needing more stimulus from the authorities for the recovery of the economy, I don't quite see that as being needed at this time.
One of our audience members worries about female labor market participation. So are you worried that you mentioned some of these workers may never come back? Are you worried that especially female labor supply may not come back?
Yeah, I mean, that's clearly something that we're staring at is, as childcare disappeared and women had to go back, mainly women, men did too, but mainly women went back and had to engage themselves in childcare. After a year and a half of doing it, they start potentially asking, should I go back to work or should I just stay and take care of my kids? By the time you pay for daycare, the taxes, everything else, you start asking, would I just be better off at home? That's fine. Whatever their choice is, that's their choice. It's not my job as a policymaker to tell them, no, you have to leave your kids at a daycare and get back to work. That's not my job. So while it's a concern in the sense that it changes the number of women in the labor force, that really is people's individual choice if they want to come back. Now, the question of whether if they want to come back, but there's no daycare available, that's something I think, again, eventually will work itself out. That's more of a short-term problem. They had the daycare before. Presumably at some point the daycare will come back.
Another question we have, especially in California, is that a lot of our incomes basically get eroded because we're spending so much on housing. And so you mentioned rents and housing costs in your talk already, but I just wanted to double check what you worry about in the housing market. Basically, some people say if the Fed keeps interest rates low going forward, there's a worry that house prices may increase further and just stay high and even increase further. Is that a worry? Is that a concern for you?
Yeah, I've been very concerned about housing prices for the last 8 to 12 months. I mean, the rates of increase at which we're seeing, I mean, it makes you immediately think there's some kind of excess or bubble or something wrong that's out of balance. But if I think, as I've thought about this more and more, we have a fundamental change in demand for housing for a couple of reasons. One is we're not going back full time to work, most people. It's going to be working from home remotely a couple of days a week. So once people realize that, they want more space, they want more privacy at home. They don't want both husband and wife sitting at the kitchen table trying to do Zoom calls. They want their own space, they need more space. And so we've seen a fundamental shift in demand for housing just because people are going to use it for their workspace. The second factor is we've seen the millennials finally come off the sideline in terms of buying homes. You know, they rented, they stayed in with their parents, and now they're finally out and ready to buy homes. So you've got that generational demand, and that's not going to necessarily go away for a while. So that's on the demand side. And then again, with interest rates low, this makes housing cheaper. And we know that when you lower interest rates, asset prices go up. Shouldn't be any different for that than any other asset price. So that cheaper financing is driving, demand up. And then that demand, depending on supply, is getting capitalized into the price of the house. And then we do know we've had a shortage of housing. After the housing crisis, we're short some staggering, something like 40 or 45 million homes that would have normally been built with population growth that never got built in the last 10 years. So on the supply side, we don't have enough homes. So you put those together, and these are fundamental reasons for prices being high and continuing to go up. So the only way to deal with that, at some point, interest rates will tend to go up. That should put some downward pressure on housing demand. And people in California, from everything I know, they're moving. They're going to Utah, they're going to Idaho, they're going to Phoenix, they're going to Texas. They're taking their money and they're getting out and buying. We got plenty of inexpensive houses in St. Louis. Come on out. So yeah, that's what'll happen. People either move, that'll again take some of the pressure off, and then eventually you have to build the houses, and that becomes a stickier problem. But that's the way to deal with it.
Are these rising housing costs something that matters for your long-term outlook for inflation? Do you think about, as you're thinking about sort of the model, what long-term inflation is going to look like? What is that one of the determinants that is going to be important going forward?
Well, yeah, if you look at either the CPI or the PCE, housing is a big component of that price index. But that it's very hard to truly measure the cost of housing. It can't just be the house price. That's an asset. So we don't measure stock prices going up as inflation. You don't measure, lots of things going up as inflation that are just pure assets. So you have to think about the user cost of the home. And then that's a trickier problem. We don't measure that every month. Those measures come out infrequently, so they don't show up right away. They tend to show up longer. But in terms of thinking about it, housing is one of the most important, biggest expenses we have. So it has to be a factor in how we think about inflation. Food and energy are things that, particularly lower income groups spend a disproportionate of their income on. So, we have to look at all these things. We can't just, that was the point of my speech. You can't cherry pick and say, throw that one out, throw that one out. Those things matter to people. You can't just ignore them. You have to take into account all these different price increases, and housing is one of them.
You mentioned high equity valuation. So let me ask you about those. So, if I look at stock markets, equity prices are sky high relative to fundamentals right now. Are you worried about that as a financial fragility measure, just valuations being very, very high?
Yeah, the valuations are high. They could be high for some fundamental reason. Corporate profits have been amazing for the last 2 years. I didn't expect that at all. And so in some, that's driving equity prices. Low interest rates, again, tend to have an asset, increase in valuation of all assets just through standard asset pricing equations. And so, the thing is, I've heard high asset things for so long, and that they were in a bubble, that I have kind of a jaded view of it when people start talking about it. And finally, we have an entire group at the board that studies financial stabilities. They keep an eye on this. And yeah, their valuations are high, but we're not seeing anything dramatic. And one thing I always try to stress with people, that if stock prices fall, that's all equity. That's typically not going to cause stresses through the banking industry, through debt instruments. You know, the dot-com bust was a perfect example. It bust, a bunch of people lost wealth, but nothing happened to the banking system and the financial system. So yeah, some people took a bunch of risk and they lost a bunch of money. That's capitalism. Get over it. But as long as it doesn't have big knock-on spillover effects to the rest of the economy, then I'm not going to worry about it too much.
Let me ask about a question that we're debating right now that might affect banks tremendously, which is the idea of introducing a central bank digital currency. And so the idea is floating around. China is already leading the way of introducing their digital yuan. And so the question is how do you view this development? What are sort of the pros and cons that you see?
Yeah, so I gave a speech on central bank digital currency, and I'm kind of a skeptic of it because I think it gets caught up in the whole crypto asset DeFi world. That's all a technology, and it's not. It comes down to a very basic policy question. Since the founding of the Fed has its operational role in the payment system has basically been to be in the background. We let the private sector banks process payments for firms, households. We make sure the payments get cleared across the banks in the background. What a central bank digital currency is a decision to directly step into the clearing of payments for households and businesses and allow them to circumvent the banking industry. That's it. That's all it is. All the central bank digital currency is the instrument for doing that. So that's what I keep trying to stress to people. It's not about the instrument. It's whether the Fed should be stepping in and taking on that role, directly competing with private banks. Now, I'm much more of a free market, stay out of the way kind of person. So I use an example that because of climate change, we want to move people towards electric cars. Electric cars are very expensive. Should we have the government step in and start producing electric cars to drive down the cost? I don't hear anyone saying that. But somehow when it comes to payments, this seems to be what a lot of people are advocating the Fed do. So at the end of the day, we may decide to do this, we may not. I personally believe we need congressional authority to do it if we go ahead. This is a major step in Fed's responsibility in the payment system, and I would not want to leave it up to just some unelected monetary policy people to make that step. I'd rather have Congress legislate it for me. But we have a discussion paper that will be coming out at some point here, which lays out kind of the pros and cons of central bank digital currency for the public to comment, and then we'll take that comment back and move on from there.
And so you mentioned crypto already, so let me ask you about cryptocurrency. What do you think about it?
Yeah, so crypto, I've been involved thinking about crypto for many years because of my co-authors, Alex Berenson and David Ondefato. We've worked on this, thought about this, privately issued fiat objects. In theory, it works just fine. There's no reason it can't. And people used to tell us we were crazy when we would say that. And guess what? It's true. So the thing is that with Bitcoin, and a lot of Bitcoin in particular, is it really has turned out to be, I refer to it as electronic gold. It's a store of value. As long as I think somebody else will pay me for it. This is just Samuelson OLG 1958. You can take a intrinsically useless object and give it value by transferring it across time. And I think of gold that way. I don't think there's much intrinsic value in gold. So, but people trade and hold gold all the time. So that's how I kind of view Bitcoin. It is not at the stage of being a payment instrument, nor do I think it ever will be. Partly because of the fluctuation in value, just like gold. We would never construct a payment instrument out of gold, literally now. Now, on the other hand, stable coins, that's a different animal. Okay, stable coin is really something closer to a bank deposit. You go to the bank, you put $1 in, you expect the bank to give you $1 back. When you have it in your bank, that's private bank money. That is no longer a central bank liability. That's private money. The same is true with a stable coin. I give an issuer $1, they give me their object. That's like a bank deposit. Now you could think about a stable coin world where the issuer takes the deposit, puts them in very safe, liquid, short-term government assets, and then does payments for you, just like the banks do. That would be a nice form of competition in the payment industry. It didn't require the Fed to step in and somehow drive down payment costs. But you introduce the usual run risk problem. You made these deposits, you kind of promised redemption. You have these assets. Can you honor the redemption? And if you can't, you have a run potentially on those instruments. So that's where the problem with stable coins is right now, is they have a potential to be a competitor. My job is not to protect the profits of the banking industry, but I want to have competition in payments, and stable coins are one way that could be done, but there's still a lot of work to be done on the regulatory front, ensuring that these things truly are safe payment instruments. But I think, they're as a way of conducting payments in the future, as long as they're pegged to the dollar, I can see that happening. Now, right now, all the stable coins are being used on the DeFi Ethereum network as a way to move in and out of crypto asset positions. They're not really being used as a retail payment instrument. But this is what Facebook and DM kind of is looking at. Could we create a stable coin that would actually be used in the retail space for payments among individual customers and firms? And we're studying all this, and we know this is a first order of importance policy issue, and all the regulatory agencies are looking at it right now.
I completely agree with you, but I also see lots of people getting very excited about crypto. And so I wonder, should the Fed do more? Should there be more financial education about exactly what you just explained? Should we do that more?
Yeah, I think the financial. So here's what you've got crypto, you've got technology, you've got all these things, DeFi, and that's where people kind of get confused what CBDC is. They get it mixed up with all of this stuff, and a CBDC is none of that. And it's important to try to explain that. I've actually given a lecture at Notre Dame, and I'm doing one at the University of Georgia in a couple of weeks. It's titled "Demystifying Central Bank Digital Currency." It's trying to make it clear to people what it is and what it's not in terms of crypto. We'll see how, the students seem to like it. It's a nice educational device. Yeah. But I agree. This is what I realized, is that people don't seem to have a demand for central bank digital currency because they really don't know what it is. Mm-hmm. It's very hard to have a demand for something if you don't know what it is. So they think it's Bitcoin. They think the Fed's going to issue a digital token that can be transferred peer to peer, and that has nothing to do with it. And that is not what China has done either. There's another fallacy that somehow China's ahead of the world on this. China has basically agreed to let their citizens have a checking account with the People's Bank of China. That's it. They can now pay their electric bill through the Bank of China. That doesn't sound like threatening global domination of the dollar in any way I can think of.
The question is whether central bank digital currency in China is going to force a lot of international payments by corporations through digital currency at the Bank of China. Is that a threat? Do you view that as a threat?
Yeah, I actually don't. I don't know why. I mean, you could do this now in some sense. You could report all your transactions to the Chinese government. They could force you to use the Chinese yuan right now if you wanted to do transactions in China or with Chinese companies. They don't do it. So they could at some point. If you were an American or European firm and you were saying, should I run all of my transactions through the People's Bank of China so that they can observe everything I'm doing? I can't figure out why you would ever do that. So again, I don't see the Chinese CBDC being a threat to world commerce or the dollar in any way, shape, or form as a reserve currency. People use the dollar as a reserve currency because of a lot of other reasons. Trust, rule of law, all these other things. Not because they can do it digitally. They already do it electronically and digitally.
I agree. There is a question from the audience who asks about the role of China more generally about monetary policy in the US. What do you think is the role of China for monetary policy?
Well, I guess I kind of lean towards the classic international finance argument that if you do anything like exchange rate pegging, you're just importing the monetary policy, the currency you're pegging to. Most of what I see from China for most of the last 20 years is pretty much pegging to the dollar within a very narrow range, which means they're basically importing US monetary policy. So for them to be in a position to influence everybody else, they would have to abandon any kind of exchange rate control, at least in my economic understanding of this. They don't seem to be anywhere near that point. At some point they could, but then it would be no different than us with the ECB. The ECB is a major central bank. Europe's a larger economy as a whole. The Euro area or the European Union is a bigger economic zone than the US. It doesn't seem to have diminished US monetary policy's impact on economic activity. So I'm not really concerned about China.
Are you concerned that the dollar may lose its status as a reserve currency? Is that something that you're worried about?
Well, like I said, the US dollar is the reserve currency for a lot of reasons. Like I said, rule of law, good monetary policy to keep it fairly stable in terms of value, willingness to accept it and trust it. It's not going to be debased. It's not going to be turned into a political object. That happens in a lot of countries. So there's a lot of reasons people want to use the dollar as their unit of account in contracts, payments, invoicing, and they don't want to use other currencies. They certainly could. I remember 20 years ago, this was the thinking that the euro was going to supplant the dollar as the reserve currency. Hasn't done it. So it's very hard once everybody gets into the system of accepting this one object as the medium, unit of account, payment, invoicing, to then suddenly all uniformly globally switch to some other one. You have to kind of ask, what is the big gain? What happened with the other one? What am I gaining by doing it? And then people are like, there's just no point. So again, I don't see a big issue with that.
There's a lot of worry about employment, inflation, and sort of the real side of the economy. And do you see any worries about financial markets?
Well, we have a group at the board that does financial stability, and they look very carefully, and they give us a financial stability report a couple times a year. Should be coming up soon. They keep an eye on all of this stuff. We get briefings as governors regularly on financial market conditions. Before every FOMC, I talk to market participants to get their views. I don't talk to them. I listen. They talk to me about what they're seeing and what things that may be issues. So we're always keeping our eye and monitoring all this stuff. I don't see anything that resembles a credit bubble, right? Every time I look back, I see problems because there was excessive credit creation. We're just not seeing that. The housing bubble is not a credit-fueled bubble. If anything, it's equity-driven. Yeah. There are more cash deals in housing than ever before. So this doesn't mean, so even if housing prices were to plop down 10%, it's going to be absorbed by the equity of the owners, not by the banks, like we saw in 2007 and 8. We're not seeing anything distorted in credit lending by the banks. They're very well capitalized. So, I mean, I'm just not seeing things that we would normally say would cause financial instability or something that could cause a major financial market problem.
Suppose the risk of higher inflation is going to become true and inflation is going to stay high for a longer time period. Do you then view that as a risk for equity valuations, or what are sort of the risks that we have to worry about?
Yeah, it's my job to make sure that doesn't happen. Yeah, if you get to that point, we've failed miserably in our job to keep inflation down, because that's the whole point. I was trying to stress that in my speech. We can worry about the employment leg, but if inflation expectations come unanchored, we've got to put that aside and get those expectations re-anchored. Everything hinges on that. So the minute we start seeing anything that looks like unanchoring, you're going to see some action to get those things back in place.
And then is it going to be mostly just tapering of asset purchases or reduction in asset purchases, or will there be other instruments? So if in the event that inflation is going to be higher and stay higher and even increase maybe?
Yeah, that's what I was talking about in my speech, that you would see probably a more aggressive pull forward of rate hikes. So, right now, about half the committee has rate hikes in 2023, but if inflation were to continue at 5% into 2022, you'll start seeing everybody potentially, well, I can't speak for anybody else, just myself, but you would see people pulling their dots forward and having potentially more than one hike in 2022, if that was to materialize going forward.
Could you imagine also just selling assets that the Fed has accumulated on its balance sheet, or won't we see that?
So that's a balance sheet normalization is something we haven't approached yet. And the question of, what size should our balance sheet be? The one thing I've learned for the last 10 years is previously when we did the large asset purchases, we blew up our balance sheet to 4.2 trillion. And everybody was like, oh my God, the world potentially is going to end. Nothing happened. Switzerland's now at 100% of GDP in their balance sheet. Japan was trying, I don't know if they made it, but at one point they were targeting 100%. We're at like 30. So we have no economic theory of how large a central bank's balance sheet should be. I've never seen it. If somebody's got one, let me know what it is. And so what I kind of find amazing is, while there was all this attention on the size of our balance sheet in 2013, 14, 15, now our balance sheet's at 9 trillion or close to 9 trillion. Nobody's talking about it. Nobody's having any great concerns. And then one other aspect of our balance sheet, it's fairly short maturity this time. We didn't extend the maturity out. So a large part of our balance sheet could actually roll off in about 4 to 5 years. So at most, it's if we wanted to, just letting it roll off, not reinvesting, you could shrink it quite a bit just in a couple of years.
Great. We only have a few minutes left. So let me ask you just very broadly if there's anything that keeps you awake at night, any risks that we didn't talk about.
Yeah, I guess like I said, right now, my biggest risk is just that inflation doesn't come down. And just for reasons we can't think in our heads, some psychological factor in the parts of households and firms, they just start building in 4 or 5% price increases, 4 to 5% wage increases, and this thing takes off. And if we're not ready to go or have the courage to deal with that, then it starts looking like the 1970s. And by God, we learned that the hard way, and I don't think any of us want to ever go back through that. So we're on it, but we're doing our best, and we're ready to stand and stop it if it starts to happen. But that would be the one thing that still keeps me up at night.
Great. Thank you so much, Chris, for being here today. We're very excited. I would love to go on. In fact, I would love to continue this conversation, but I know that we're limited in time until 1. So thank you very much for your talk and your discussion. This has been great. Thank you.
Thank you very much for having me. Hopefully we can do it again sometime in person.
Yes. Oh, yeah. I'm looking forward to it. Thank you very much. And thanks, everyone, for listening. Thank you.
Thank you, everybody.
Bye-bye.